I'm not going to go backwards on that, but we do have an outline that we're going to cover, and so I'm going to let Jared pick this back up, and that way we can get back on track.
Yeah, sorry about that. So April 2020, 93% of respondents think that we're going to be in a recession over the next 12 months. Only 57% think that equities are going to be the best performing class for 2020. And the estimate for the S&P was actually revised down about 15% to 29.29. When they were asked in January of 2020, the biggest thing that was on people's mind was the concern around political risk and trade uncertainty, right? We had Trump essentially he's going up for re-election in November, and the questions around who was going to be on the Democratic ticket, and then also trade uncertainty with the China kind of trade tariffs. So now 74%, so out of 3 out of 4 people are pretty much concerned about the COVID-19 and the credit market and liquidity crisis. So I think what that says in our minds is when you get everyone thinking about the same thing, most of the future volatility is essentially already priced into the market.
All right. So there's a fair amount of data on here, but and taking and looking at this survey, looking at the results, there's a couple questions in here that we want to talk about. This has been something we've had clients bringing up: is how long will this recession last? And is it going to be short, or is it going to be long lasting? And if you look at the survey results, a few people think, a small percentage think no recession. Majority think we're going to have a 1 quarter or 2 quarter recession. And actually a fairly small percentages think it's going to be longer. And we kind of share that opinion as well. So then when you start looking at, okay, when are on the top right, we look at when are the COVID-19 cases going to plateau. We're looking at the majority of these happening in April and May. And the good news is we're actually seeing that data occur today. We're already seeing New York, the numbers are improving dramatically, and they're by far the worst state here so far in the US. So that's a good sign. There's also some other questions here on how high unemployment will be. We think it's going to be pretty high. So there's a big number that's showing over double digits. We think that's realistic, but we also think that's going to be very short term. A lot of companies had to lay off their workers, and we feel like they're going to come right back to work once we get back to normal. Now, we know not everyone's going to get back to work, but a high percentage of them are once we get back to some normalcy. And then the bottom right, when's the S&P going to bottom? That's the magic question everybody wants to know, right? Am I going to be able to buy this thing perfectly at the bottom? Short answer is no. We think there's a chance, we've already seen it, that those lows a few weeks ago. But we do know that and history suggests this, that we're likely going to see a bottoming process, which means we still have more volatility ahead. And kind of the summary of what we're looking at here is that we think that the markets are going to be bottoming over the next 4 to 6 weeks, and that the economy is going to find a way to bottom over the next 4 to 6 months. So that's kind of what we're looking at as a summary.
This is the COVID-19 case cycle. So you can see there's a bunch of different countries on here, and it's essentially countries that have either peaked with cases or haven't peaked yet, which is the United States. So you see that we're still kind of at the top there. Countries like China, Japan, Italy have kind of crossed the apex and are on their way down. What they're saying is with the United States is we could maybe see the peak in the next 2 weeks. So I've been reading as well as the April 15th date. So not tax day anymore. It's actually the day that people are saying that we might peak. So I think the concern is on the bottom piece of this is China. You can see is towards the bottom here, but the risk is they're already starting to get their economy back online. People are starting to go back to work. I think the concern is that there's a second outbreak, right, or a second wave of infections. And so I think that needs to be closely monitored. Depending on what happens there, I think that will impact how other countries maybe get their economies back online and get people back to work.
All right, so the one thing that we recognize coming into this is that our U.S. economy was pretty much on a record tear. If you look on the chart on the right-hand side, shows the expansions of basically the length of economic expansions, and the top line was 2009 until today. So it was the longest on record. Many of you have attended workshops that I've hosted in the past. We knew that this was the longest on record. Now, we just gave an economic and market update a few months ago. Obviously, we weren't predicting what's happening today. So it does look like this economic expansion is coming to an end. Again, it's the longest recovery that we've seen. And, you know, the one thing that we have to recognize, though, is we're going into this recession in a very strong position. Our economy was quite healthy going into this. That's one of the reasons why, with all the stimulus that we're seeing, why we're very confident we're going to make our way through this. Again, a lot of uncertainty, and I know a lot of people are just scared about what the outcomes are going to be. But we have a lot of confidence that our economy is going to find its way back to more stable footing.
Yeah, this slide shows pictures of what's been happening. You have school closures, businesses closed down, airlines essentially operating, and not many people are flying right now. I think it's pretty hard to say that we're not in recession, because companies that even want to keep their doors open essentially can't. So they're being told that they can't even do business even if they wanted to. So I think what I've been thinking about is the difference between 2008, 2009, and now is companies were essentially laying off a majority of their workforce, maybe 50% or 80%, and retaining a small portion, but they still had their doors open and were functioning at a lower capacity, but they weren't closed, right? They weren't fully closed down. So we're seeing companies, schools, other businesses that are essentially being forced to close their doors. But like John said earlier, I think when we're allowed to get some normalcy back, the economy gets back online, that companies are going to be able to get back online and get business flowing pretty quickly.
All right, so this next chart this is a good chart that Raymond James put together, and you know, it's basically kind of the call of the official recession is going to be delayed, because technically to be in a recession, you have to have 2 consecutive quarters of negative growth. So the first quarter of this year, we did not have negative growth. The second quarter we just entered, we're likely to. The third quarter is unknown. But because of how quick the job losses have been, so if you look at what we're looking at on these charts here, so let's just talk about how do we determine which tools you would utilize to actually determine the recession. So real GDP, so the impact of the overall economy, economy-wide unemployment, or excuse me, economy-wide employment. And if you look at the first chart on the left, it shows that jobless claims have gone to record high, 10 times the previous record high, 10 times the previous record high. So it shows you the severity of these job losses. Real income, real sales, and industrial production. Those are all the things that help us forecast the recession. And so when you look at the data, we've had sharp spike in jobless claims, and then a massive contraction in you know, different indicators that show that we are in a recession, even though by textbook, we're technically not in one.
Yeah, so I think the interesting thing is, in quotes here, determinations of a recession have taken between 6 and 21 months. There's essentially no kind of rule on timing. But what that says is we could essentially be out of a recession before it's even formally declared that we're in one. So which
is really interesting.
Previous U.S. recessions, this goes back to 1947. The U.S. economy has experienced 11 recessions, and then if we're in one right now, this would be the 12th. So what this shows, you can see going back to 47, the trajectory of the market is positive. I guess that's a nominal GDP, but it's going up, right? But there's been 11 recessions over that time frame. I think what this shows is recessions are normal. They do happen, but the cause of this recession is not. I think this would actually be the first virus-induced recession ever. Yeah, and so, you know, obviously the last two are more about elevated valuations, and you can see some of the previous history around monetary policy or energy crisis. And so, yeah, it's pretty remarkable that we're having this conversation. Yeah, I mean, this started as, it didn't start as a financial crisis, right? It's basically a health pandemic, a health crisis that's turning into a financial crisis because of the impacts it's having on society, on businesses, on kind of the overall global health. But yeah, it didn't start that way. I mean, like John mentioned in a previous slide, we were really healthy going into this. So I think that should give us a little confidence that once we do get out of this, we'll be able to. All right, so I know as we've looked at slides in the past couple weeks, you know, the big thing that's helping to drive the health of
the economy, or sorry, the rebuilding of the economy is what the Federal Reserve is doing. So the Federal Reserve is, when you look at what they're trying to do, it's what's known as quantitative easing, which basically means they're trying to stimulate the economy. So their 5 goals of trying to stimulate the economy to keep things moving forward is to boost confidence, reduce volatility, keep interest rates depressed, narrow the fixed income spreads, and increase asset prices. And so the first 3 are pretty easy, right? If you boost confidence, keep the economy moving forward, reducing volatility obviously helps with kind of a mindset of being fearful of what's happening out there, and then also keeping interest rates depressed is very good for homeowners, good for anyone that has debt they need to refinance. So keeping interest rates down is obviously a very healthy thing. The 2 on the right are a little bit abstract, narrow fixed income spreads. And so what happened just a few weeks back when the panic was at its height, the markets were not performing properly. And so basically spreads in the markets, meaning interest rate spreads in different environments, and I'm getting a little technical, I realize, but they got way out of whack. So this chart in the middle just shows you what a normal environment looks like and what we went into where they spread, which means basically these assets lost 4, 5, 6, 7%, and these are safe assets. And then on the far right is really the balance sheet of the Fed. So the Federal Reserve, when you think about balance sheet, essentially they're printing money. So by printing money, that's actually driving asset prices up. It's driving real estate prices up and helping to drive the stock market up. And this shows a chart going back to 2006 and shows how the stock market is kind of tracked pretty nicely with what the Federal Reserve is doing. So, obviously we want to grow organically, but given the time of the crisis that we're in right now, it's key that the Fed takes these steps to stabilize so that we can move forward. And then we've spoken over the weeks about the fiscal stimulus. I was pretty early on saying that this stimulus was going to be massive. That was the $2 trillion phase 3 that they put in place. If you look on the right here, phase 4 is on its way. There's now chatter, and there's actually probably more than that today that's happening in the House and the Senate about what's next. Infrastructure spending to create jobs, that's a big piece, is starting to kind of rebuild America. So putting people to work. Hazard pay for frontline responders, those that are putting themselves in harm's way, is actually pay them a premium. Debt relief for individuals and households, those that are struggling to get back to work and have some debt that they just can't service. So there's going to be packages for that. And then also direct funding for hotspot cities. So those cities that are getting hit harder than others, is making sure there's more federal dollars going into those cities. And so phase 4 is on its way. I don't think it's as critical as phase 3. So it might take a little longer to work through the details because there's a lot of political issues in the phase 4 on how they're going to put this out there. So we'll see, kind of stay tuned. I mean, again, we'll be back next week, so we'll be able to give you an update. I don't think phase 4 is going to be done by then, but we'll see.
I mean, it could be a good thing that they actually take a little bit more time this time, right? I mean, it was really important to start getting that stimulus in the economy, but now it might be a little bit more methodical. I was hearing that May might be a date that they start rolling that out.
Yeah, which hopefully, when you rush any decision, generally it's not the best, but we were really at a panic phase, so we had to get some things out there.
Yeah. What this chart shows on the left is kind of in line with the previous recessions going back to 1947, I believe, 48. And there was 11 other recessions. If we're in one, this would be the 12th. And so this is 2020. So this is actually showing that the markets were down about 33 or 34%, which is in line with the historical average, given those other 11 recessions. That was on average 29%. So we've actually slightly exceeded what the average was. Historically, on the right side, it actually says equity markets tend to bottom 4 months prior to the end of a recession date. So I think going forward, if we're technically in a recession, that could mean that a bottom is in sight.
Yeah, and I think just to add a little bit to that on the right-hand side, one of the things that I think as investors, people kind of have this idea of, well, why don't I just wait this out? Now, there's so much volatility that it's not advisable. We don't think you should. But people have this idea, I'll wait it out until it gets better. Mm-hmm. And if you look at the chart and you look at the line where it says 100 on there, that's where kind of the start of the decline occurred. By the time that we're out of a recession, it's kind of back to those levels. And so that's one of the things that tends to happen is that, by the time the news starts to get good, the markets are already going to be off to the races ahead of that, because that's just how they operate. They're forward looking. And so trying to time things and trying to get cute with, I know when this health pandemic is going to peak and all that, it's just not a great exercise to waste time on, because it's kind of a guess. And, we're not in the business of trying to guess for you. You haven't hired us to do that. We need to have discipline about decisions we're going to make. And we're going to get into a few things that we're doing inside portfolios.
We've shown the slide on the left side, or the chart on the left side. This is intra-year volatility, showing that, throughout the year, volatility is normal. It doesn't necessarily mean that the annual performance of the market is going to be negative. For example, last year, the market was down 7% at one time throughout the year. It ended plus 30. So we know that this goes back to 1980. There's a lot of years here, more often than not, where there's volatility to the downside throughout the year, but then the year ends positive. I think the most important piece of this is on the right side. Everyone loves when the markets are high and positive and everyone's making money. I think when you look at the charting here, it says average performance following a 6-month decline of greater than 20%. That's in the dark blue here. Over a 9-month period, it's 13.4%. compared to the average performance following a 6-month rally of 20%. So that's 13.4 versus, 8? And then going out 12 months, it's 18 or 19% versus about 10. So I think, like John was saying, now is a good opportunity to continue to invest those dollars if you do have them, and buying in at these cheaper prices, because going forward, it's more likely that you're going to have a better performing stock market versus if we just had a 20% rally.
Yep. Okay, yeah, so we're going to get into a little bit of rebalancing. So I'm going to get maybe a tad technical. I'm going to do my best to kind of explain through this fairly simple concept, but we're going to focus on the right-hand side. And so this basically takes an example. It says if you were in a 60-40 portfolio, so 60% in equities or stocks and 40% in fixed income and or bonds. So it shows kind of starting the year 12/31 and what the volatility of the markets did, that you would have essentially stayed right in line with your targets. You wouldn't have deviated very much. Then starting right around, it was like February 20th, 21st, I don't remember when the exact day was. You can see the equity line goes down, the fixed income goes up. Basically that means stock market went down, bond market held steady or went up a little bit. And then you can see the peak right at the very far right where these lines almost come together. At that point, that was a period in time where a 60-40 portfolio was around 52%, 48. So obviously from a rebalance perspective is way out of alignment. And then you can see now that the lines have started to separate. And so a couple things. We are in the process of going through rebalancing for client accounts. We sent out an email just a few days ago to get our client accounts back in target. That's going to take a few weeks. And so we're going through this process and you'll be hearing from us. The other thing why this is beneficial is this actually is reading to show you that we probably have some stimulus built into our economic system, meaning that if everybody rebalanced, all the pension firms like CalPERS and all the large money management firms, foundations, endowments that run money, if they actually just rebalance back to their target, there would be an estimated inflow of maybe $2 trillion that would go into stocks by basically selling from fixed income going into equities. So that's the approach we're going to be taking over the next month as this market kind of hopefully finds its bottom. And we're going to use this. We always have this discipline in place. We just never know when it's going to show up. So rebalancing is something we do on an annual basis, but we're basically kind of taking hold of it right now because of the volatility we're seeing.
Yeah, we also don't have a chart on this, but I read this morning that there's the highest dollar amount right now in money market funds, which actually exceeds 2008, 2009 levels. I think it's about $4 trillion. So I think once you start getting some investor sentiment changing a little bit of like, okay, I think the worst is behind us, we can start deploying some of those dollars back, along with the rebalancing that was just referenced in the previous slide, that we can start to see equities recover.
Yeah, and so this just kind of is a little bit of a proof source for rebalancing works. You can see this middle chart shows the last 20 years, that if you looked at the S&P, looked at bonds, and looked at a 60-40 portfolio that was rebalanced when it got out of alignment by 5%, and it shows the performance was almost in line with the stock allocation. So it just shows you that over a long period of time, rebalancing does work. So this is something that we do employ for you already. This is kind of forcing our hand to do it now. We do it on an annual basis, but this is kind of triggering an additional rebalance for our client accounts. So I do want to go through one of the questions that we've been getting is around, what are you guys doing? So rebalancing is the core of what we're going to start doing, but we're also making some changes. And so one of the things that we recognize is with the recent sell-off, there are some investments that have held up better. There's some investments that have been beaten up. And so one of the things we just kind of want to remind you within portfolios is we talk about, what assets tend to do best. And we talk about assets, broad assets. And this chart shows a breakdown between small value companies, large value, small growth, and large growth. And so if you look back, this is data since 1970. Over the long term, small value has been the single best performance, and of averaging 13.9% relative to, let's say, large value at 10.6 and large growth at 8.9. So you can see there's definitely over time it shows that there's reasons to having a tilt or a small cap value bias. And so we do like value. We think that we're going to see potentially some better recovery there. Let's go to the next slide. This is actually a really simple chart. There's just a lot here. Bottom left corner is like why value after recessions. So what we're looking at here is if you take a look at different categories in the market, this is known as like a Morningstar style box in the bottom left. It shows large, mid, and small, value, blend, and growth. Large growth, this was year to date as of last Friday, is down 14%. So an asset class that's held up pretty well. And companies that you would know in there would be like Apple and Amazon and Google and Microsoft. So big names that we know. We still think that area is going to do fine. But then if you look at small value, is down 36%. So in the same marketplace, we're seeing a very different performance makeup of those different assets. And so what we're looking at here on the color charts, in terms of, it looks like it's kind of a green and a blue. The green represents growth stocks. The bluish color represents value. And the top chart is large cap stocks and the bottom is small. And so what we're basically looking at here is this shows after a recession, what the 1 month return, after 6 months, after 1 year, and after 3 years. And this is data going back to 1970. So it's taking into account quite a few recessions. It does show in the bottom right corner that after 3 years, small value has historically given about an 83% total return, small growth about 50%. And then when you look at large value, 41, and large growth at 27. A big reason for this is exactly what we're seeing today, is that because when you go into recession, smaller companies tend to underperform because they're just not as big and they tend to be a little bit more economically sensitive. Because they actually got hit harder on the way down, they have the ability to bounce back faster. So as we're coming out of this, we're trying to be opportunistic to find where are those opportunities where we think we're going to get a better bounce, which should improve results. And so those are the things we're looking at. I mean, certainly past performance is not a guarantee of future results, but those are the things that we're trying to consider and trying to position and make those adjustments. We've identified some of those changes, and those are the changes that we're going to put into place here over the coming weeks.
Yeah, I think the example that we've used in the past is Apple, let's say, is $1 trillion company. It's a lot harder for them to go from 1 trillion to 2 trillion than it is for a smaller company to go from 10 billion to 20 billion.
Yeah, or even 1 billion to 2 billion,
yeah.
Right? So it's the same type of move in the marketplace of being 100% return, but it's easier for smaller companies to get those above average rates of growth. This is just a little bit more of why value now. The main chart here in the middle basically shows there's a line that runs across it that's at the zero line. Anything above the zero shows that growth is cheaper. Below the zero shows that value is cheaper. And right now, value is significantly cheaper than the growth markets. And so it's, when we kind of build the cadence of, why value over the long term, why value after recessions, and why value now, all three of these things are kind of lining up for us to feel comfortable that this is going to be a good place to redeploy capital. And we're not giving up on growth. We always believe in well-diversified portfolios. We just think that we're actually adding a little bit more to value because we've been able to find some really good opportunities there.
So we previously talked about planning opportunities that we're thinking about for clients, and is there anything else that we should be doing in addition to any investment changes? So we've been talking a lot about Roth conversions. The definition is here: Roth conversions, moving of assets from a tax deductible or traditional IRA account to a non-deductible Roth IRA. So the example that we're using is, let's say you bought an investment at the beginning of the year for $10,000. And because of the volatility, that investment, that's in your IRA, excuse me. And let's say because of the volatility, that investment in your IRA went from 10,000 to 7,000. So the thought is you actually convert that $7,000, pay tax now, and then all of that future growth, let's say that investment goes back from 7 to 10, just what you paid for it, all of that future growth, that 3,000 is going to be tax-free. But now you have a $10,000 asset that is essentially tax-free, and then all future growth, it's going to be long-term, is going to be tax-free as well. So this is obviously not for everyone. We are kind of doing case by case and looking at this if it makes sense in our specific client situations.
Yeah, because at the end of the day, it does result in a current taxation, but we're trying to look at it over the lifetime of our clients. And there's a lot of reasons why they can pay the tax today and it'll benefit them over the long term, especially if you're younger or if you're retired and you know this money's going to your kids and it's not for you.
And if you think that tax rates are going to be higher in the next 5 or 10 years or 20 years, tax rates with the tax cuts that Trump put into place at the beginning of 2018, that could be the lowest tax rate that we pay for the foreseeable future. So, paying tax today at these lower rates could make sense. The other is tax loss harvesting. So it's basically the practice of selling a security that has experienced a loss. And by realizing or harvesting this loss, investors are able to offset taxes on both gains and $3,000 on ordinary income annually. So this sold security is replaced by a similar one, maintaining an optimal asset allocation and expected returns. So what that does is we essentially will sell an asset at a loss because of the volatility. We book the loss, and then we buy something that is very similar. So when there is recovery, we actually get an experience in that recovery. But now you have a loss on the books that can help offset future capital gains and will carry forward for every year that it remains on the books.
Yeah, we always consider this like a very investment neutral decision, meaning we know that the secret to investing is buying low, selling high. So the tax loss harvesting sometimes can seem counterintuitive, but because we're going into a similar investment, it basically becomes investment neutral. So there's no harm in doing this. It's basically a tax strategy to save taxes in the current year and years ahead.
Yeah. Retirement plan contribution. So 2019, we're saying make them now. With the volatility, we think it makes sense to deploy some of that fresh capital into the markets.
While the deadline is,
it got extended to July 15th. So obviously we have the ability to delay making those contributions, but July 15th, what if the market's up 20% from here or 25, right? I mean, if there's a recovery, then you'd be buying into the market at those higher prices. So we do think that making your 29 contributions now makes sense if cash flow allows. And then also for 2020, consider funding early. I think it makes sense, like kind of in line with making your 2019 contributions is buying in at these depressed levels. So obviously if cash flow allows. And then the CARES Act changes, RMDs, required minimum distributions, and beneficiary required minimum distributions actually have been waived for 2020. So we know some clients rely on their RMDs to pay the bills, and we know that not everyone's going to be able to not take their required minimum distribution for this year, but we do have others that don't have to take the money to pay the bills. So for those people, we're essentially looking at, does it make sense to not take the distribution this year, allow your accounts to recover, and then kind of push that to 2021.
Yeah, and most importantly with this whole list, if you have individual questions as clients, just call our office, send us an email, give us a note, even if we are not having a meeting for the next few weeks or a few months, let us know that these are things that you would like either more explanation about, you'd like to know how they would impact you. That's what we're here to help with. So just know we are going to wrap up here. So if you have any questions, here's our contact information. Obviously you got on this webinar, so you know where to reach us. And it does look like things are beginning to stabilize a little bit in the markets. We don't think we're out of the woods yet. So if we can be of any assistance, I know this is a tough time for everyone. And, if we can, even just be, someone to lean on, and, even if you just need to bend our ear and give us a call and just have a conversation, we're here to help. Thank you for joining us. And I don't know if you have anything else to say.
That's it. Hang in there.
Okay. All right.
We'll see you guys soon.
Yeah, that sounds good. Bye, everyone.